So good afternoon. My name is Phil Goldfeder. I am Senior Vice President at Cross River Bank. Cross River is a New Jersey state-chartered FDIC-insured community bank. We bring together the trust, security, peace of mind, and legacy of the banking industry and combine it with cutting-edge technology to create new services and solutions. Our focus on regulatory compliance, consumer protection, and ensuring access to credit is unmatched, and we are excited to highlight that tomorrow with a day of events here at the Lendit Conference. We are hosting the policy and regulation track, and so I urge all of you to come by for one, for all, if nothing else, just to say hello and so I don't feel all alone. Today I have the distinct pleasure and the privilege of introducing Raj Date, one of the foremost leaders and most knowledgeable experts in the area of fintech and marketplace lending, regulatory compliance, and policy. He is the chair of the investment committee at Fenway Summer Ventures, a Washington, D.C.-based venture capital firm focused on early-stage financial services and fintech opportunities. He also serves as the director for a number of innovative firms in consumer finance. For Raj, this is only just another step. He was the first ever deputy director of the U.S. Consumer Financial Protection Bureau. Hold your applause. He served as the Bureau's second-ranking official and helped steward the CFPB strategy, its operation, and its policy agenda. He led the CFPB for most of the first 6 months after its launch. Before his time in public policy, he was the managing director of the Financial Institutions Group at Deutsche Bank Securities and senior vice president for corporate strategy and development at Capital One Financial. Once again, I hope to see you all tomorrow at the policy and regulation track hosted by Cross River Bank. Without further ado, I'd like to introduce Raj Date, who will be interviewed this afternoon by Lydia Beyoud, who is the FinTech reporter at Bloomberg Law.
Thank you, Phil. Thanks for coming to this panel on changes in DC and how they'll impact fintech. Raj, why don't you start by doing a table setter? What do you see as the broad themes that are shaping DC policy in the fintech space?
Great. And first, thank you to the Lendit team for having me here. This is a considerably larger room than the one in which I spoke a few years ago, when it was just a modest little affair, and the modesty, I guess, is just straight gone now. It's also, there are a number of lights right here, which makes it very hard to see the expressions on people's faces, which for me is a major handicap, because typically when people start grimacing, I just change the topic. So I don't have that advantage, so I'm going to offend people. I mean, like a lot of people, like without question. When I run into people today who ask that kind of question, like what broadly is going on in terms of policy dynamics in Washington, they almost ask it with sort of they cringe, because it seems from time to time that Washington is more or less a dumpster fire right now from a political and policy point of view. And the good news, I suppose, is that within our little sector, said dumpster fire does not appear to be raging quite as much. And I think there are a couple of reasons for that. One is, a lot of sort of the excitement that is emanating from the West Wing right now, you can draw a pretty direct line from the campaign and campaign promises that were made to kind of occasionally, in my view, wacky things that occur out in the public sphere. And this set of issues simply was not a prominent part of the campaign, right? I mean, just think about the things that were very much sort of part of the stump speeches. It was things like, fortifying and possibly militarizing the southern border of the country, which makes a lot of sense to me because, the Mexican-American War just ended 170 years ago. But this was not, fintech and financial services, candidly, was just not a big issue. As a result, I think that we are able to have the advantage of what fundamentally are a stabilizing set of influences, mostly driven by the prudential regulators, the prudential bank regulators of the Fed, the OCC, the FDIC, and CUA, which are institutions that simply do not whipsaw, particularly quickly. They tend to change, 5 degrees at a time, and so there's a relative level of conservatism, small c, and stability within the policy landscape right now. But to the extent that there are changes underway, I think that broadly, they could be positive for the overall kind of fintech sector and some of the experimentation and innovation that might be resident therein.
So how is that stance actually impacting what you're doing in investment?
Yeah, well, I mean, certainly there are some things that we otherwise would have been active in that appear not to be particular priorities over the next few years, and so we pulled back in the investment agenda on those things. So I'll give you an example. So we had spent a decent amount of time developing a Volcker rule compliant way for banks to invest in fintech firms. Post-election, it was not obvious to me that there were going to be a lot of Volcker rule constraints for that much longer, so my enthusiasm for further developing that idea tended to wane. Similarly, there are a number of firms doing pretty interesting things around the idea of Department of Labor, fiduciary rule compliance. Like in general, if you are trying to sell a solution to a set of putative clients who don't believe that the force of the rule will be especially binding or especially soon, like that's not a great place to be in, so we certainly pulled back in some of those areas. However, the other major pillars of the strategic agenda for us at Fenway Summer remain the same as they were. We focus on things like digital distribution plays, things like infrastructure improvements, many using blockchain technologies, marketplace structures that are capital efficient in one way or another, analytic engines that are superior to those in the past. And all of those I view as sort of multi-year, if not decade plus dynamics that we're only at the start of, and hence we continue to be active.
So you mentioned the OCC, which regulates national banks, and one of the bits of news from that agency today was that the comptroller said he would make a decision on the FinTech Charter in about 2 or 3 months. It's kind of an ambiguous statement. I'll make a decision. We don't know what decision, but how do you think that might shake out?
I'm going to start previewing decisions that I may make 2 or 3 months from now as well, because so I don't know what one is supposed to glean from that. I will say that, in my opinion, I mean, who cares what I think, but I do think that the notion of a FinTech Charter is quite a good idea. And I think it's quite a good idea because when you think about the bundle of things, sort of the sine qua non bundle of attributes that make a bank, there's something sort of historically driven and arbitrary about that bundle of things that's special about banks, that if we unbundle them through one or more means, including a FinTech Charter, I think it would be better for practically everyone involved. So when I say like the attributes that really make banks special, one is historically, right, privileged access to customer transaction data. It's privileged access to leverage. I mean, how many operating companies do you know that operate, with capital levels so low? Privileged access to the payment rails, and then finally privileged access to, in the miracle of our federalism, to choice of law. Banks, for the most part, can preempt a lot of state laws, and finance companies simply cannot. That last one, having a uniform set of rules with respect to a number of businesses that are naturally national scale in terms of their fixed cost bases, need not be stapled to all those other attributes. So if you want to have the benefit of a single set of rules and the benefit of federal preemption, it is not clear to me why that has to magically only reside within something that happens to have FDIC or NCUA insurance. Like that to me does not make sense. I think that if you're kind of designing the system from a blank sheet of paper, you would never arrive at that outcome. And that's why I personally think it would be quite a welcome change to be able to have something like a FinTech Charter so that we take advantage of the fact that we are a 300 million person plus country. We ought to take advantage of some of that scale.
So what do you think happens if the decision is we're going to drop the charter?
That very well could be the decision, and I think moving in the other direction of that impulse is the fact that FinTech and bank partnerships continue to accelerate, I think, which sort of synthetically creates many of the benefits that a FinTech Charter would more directly supply. Certainly you see that with respect to marketplace lenders that originate with an originating bank partner, the Second Circuit decision in Madden notwithstanding. You see that in terms of niche providers of everything from RegTech to cybersecurity to payments technologies that operate through banks and bank customers. And all of that is moving into, I think, a climate that feels a little bit more conducive and easier to get done right now in terms of those bank FinTech partnerships than perhaps 5 or 10 years ago.
So your former agency, the CFPB, is in a lot of flux right now. It's under new management, not just with the new administration, but also sort of an acting director through Mick Mulvaney, who's also the head of Office of Management and Budget in the White House. What do you think about some of the changes happening at the CFPB, and how do you think the new management's going to think about FinTech and take any action with regard to FinTech?
Well, I would not expect a ton out of the interim director right now. Like the reality is that the Vacancies Act, which is sort of it is the federal law by which the president can put someone who is confirmed for some other job into some open job. That's not the kind of thing that lasts forever, and so there will, believe it or not, eventually be a nominee from this administration to run the CFPB. And that person, depending on who it is, could really have, I think, a quite profound impact to the positive with respect to the future trajectory of consumer finance in the US and the efficiency and effectiveness and safeness with which it is provided. I personally would not infer much from what is going on right now, which is too bad because, could be that not very much is going on right now. And, the agency does cost $50 million a month to run, so it would be nice if it were zealously pursuing its mission.
Okay, so at this conference, there's a big focus on the use of data, alternative data for loan underwriting and other uses. We're also seeing a renewed focus on Capitol Hill and among regulators about consumer privacy, how consumers can use and consent to their data being used. Let's say, what happens if Congress decides to make some new laws or put new restrictions in place with regard to data? How might that impact not just tech companies or finance, but sort of this ecosystem that they all thrive in?
Yeah, this is, so imagine, for example, the US Congress moving forward. First of all, just let me stop that sentence right there. Imagine the Congress moving forward. But you get through the midterms and then there's some energy around this set of issues, which I think would be entirely appropriate. And then let's say that we were to move to something that looks somewhere in the ballpark of what Europe is, about to implement. I think that there would be across the banking industry like a reflexive gasp, whoa, that's terrible, it's a new set of rules, this is a disaster. But paradoxically, I think it would probably be better for banks. And I don't mean all 7,000 banks and 7,000 credit unions, but I mean for the big 5 or 10 banks with big consumer franchises, if there isn't one or more people already working on, gosh, we know a lot about our customers, and maybe we should use that data to construct services, products, experiences that they will find delightful and engaging. I assume that there are pools of said people working at each one of those institutions today who, paradoxically, I think would be able to more zealously pursue that mission if there were a set of relatively bright line guardrails with respect to the use of data about customers. Because I can tell you for sure, right now what we're headed towards is a lot of high-profile examples of problems wherein the existing guardrails are, at best antiquated and, at worst counterproductive.
Well, how about the impact on non-banks and startups, the groups that you fund?
Yeah, well, I mean, the reality is that it will further, I think, add to the fixed cost burden of being a small player in financial services and in consumer financial services broadly. The fact of the matter is consumer finance is a pretty scale-intensive business, and although there have been some tech innovations that have variabilized some of those costs over time, so when I graduated from Cal Engineering in 1992, if you wanted to be in a consumer-facing technology, you were going to have to own, I don't know, a server at some point. The variabilization of a bunch of costs within this business is breathtaking. That doesn't mean that it's not a scale-intensive business, notwithstanding. And as a result, I think this would, on the margin, make things a little bit tougher for small players. I don't think it's a big non-bank versus bank driver, but it is a difference between relatively small, thinly capitalized firms that are only now building out a customer base.
So there's a lot of focus on national regulators, but the states in the US play a really important role. And at the same time that the CFPB has said, hey, we're going to step back from regulating or enforcement in certain areas, a lot of states, I think New Jersey is one of the most recent ones, have said, well, we're going to step in. So where do you see that headed in terms of state regulation?
That is definitely going to happen. And I'll tell you, this is, now look, on the one hand, I'm sympathetic to the acting director at the CFPB in that, he is a politician from South Carolina, and for 200 years, politicians from South Carolina have been fervent believers in states' rights, in sort of in the miracle of our federalism, and here's where that doesn't work in this actual business, is that when you leave things up to individual states, you're not letting 51 flowers bloom. That's not real life. What happens is the federal government ends up just sort of abdicating its responsibility that will get taken up by attorneys general who are well-meaning, who are in the states that are the biggest and therefore you can't not ignore them, or they happen to have the most resources at that moment in time. That's what will happen, because if the federal government wants to just say, forget it, you guys work out your own thing, and we're going to step back from any kind of like significant supervisory enforcement or rulemaking activity, well then we're all basically going to be following California's rules. That's what will happen. There's a reason why these services, products, institutions tend to be regulated at a national level. I don't even remember what your first question was, but that's what I think. Oh, yes, but in any case, you're already seeing it. To your point, like New Jersey, Pennsylvania, these are, one fun thing to do in LinkedIn is to look at where enforcement lawyers from the CFPB have been going. The ones who are going to the public sector are landing in places where I would expect there to be relatively robust state-level enforcement. I keep getting Stormy Daniels updates on my phone. I should turn this off.
While you check the Stormy Daniels updates, just one more question, or a couple more questions in the time we have left. So right now, the federal regulators are really encouraging banks to get back into small dollar lending, but there's a lot of fintechs already in that space. So what do you kind of see as the challenges and opportunities, or the lines that might be drawn there if banks ramp up small dollar lending?
I think we have a pretty significant impact, not on everyone, but certainly some. So for example, we started a credit card business in order to try to better serve that plurality, not majority, but plurality of payday loan customers who do in fact have episodic, not chronic, like structural, like insolvency, but episodic, idiosyncratic cash needs. That need will still be there, and it's not one that will especially change given if, for example, the deposit advance product guidance were to change. But things like payday, I think that would be a tough outcome for the payday business, that's for sure. And the reason for that is every payday loan customer has A, a job, and B, a bank account. And banks' marketing costs vis-a-vis what payday companies' marketing costs are for the same product need is like something that is vanishingly small. I think that if, initial conditions matter, right? If the initial banks that were pretty active in the deposit advance space had been a little bit more far-reaching and thinking about strategically how to play out their growth and their pricing structures, I think they would have eaten the lunch of the short-term small dollar lending business in the U.S. some time ago.
Well, how do you think growing those product lines by bank will impact this Bank FinTech partnership model?
Well, I don't think you're going to find a lot of banks providing that need even through partnership today. Right, because that particular need is actually suited to a quite short-term infusion of cash, as opposed to like more of a revolving product and the like. I think it would allow banks to, and again, it's not going to be every bank, it's going to be large banks with big installed consumer bases, allow them to be able to address that quite legitimate need. Now, it doesn't change the fact that banks are, by intention, tend to be liability-driven economic profit engines, right? Like in general, through cycle, economic profit gets driven by the right-hand side of the balance sheet, not the left. And so it's hard strategically for most banks in the country to really wrap their hands around the idea of customers being core parts of the franchise if they don't have any money. Like that's going to remain true. And so the product like this becomes difficult to really keep strategically at the bullseye for any significant institution. And that will remain true, and why there will always be room, I think, for excellent, customer-centric, niche fintech providers.
And a last question. People talk a lot about cultural clashes or cultural differences between DC, New York, the Valley. You came to DC some time ago. Do you think that those lines have changed or shifted a little bit?
I mean, things have shifted a little. I mean, and it could be that most of what has shifted is in my own mind, right? When I came down to Washington, despite the fact that I had been with Capital One for a number of years in the DC area, I had somehow managed to do that entire time without spending anything within policymaking circles. So I was completely ignorant of more or less everything about how DC works. So when I came down to join Treasury in whatever year that was, 2010, everything was new to me, and I was sort of surprised and in general gratified by how it is that away from the Hill, how the executive branches and the administrative agencies actually function. The reality is, all the hype aside, professional people do not go to Washington, D.C. to work in and around government if at some level they don't care about the institutions of the democracy. Like, like until very recently, I would have said that in an unqualified fashion. And when that is true, when people actually care about the institutions of the democracy, it is possible to engage in a constructive way, and that's terrific. Now, like there has never been a time that I've been close to policy or politics in DC in the House where that has even remotely been true. But I think even when I arrived, like on the Senate side, things were certainly more constructive than maybe they feel right now. We have the benefit of our portfolio is spread, the two biggest areas geographically where our portfolio companies are New York Metro and in San Francisco Bay Area. And you definitely see sort of the cultural differences. It's very difficult. I think it's historically people think of New York as being much more sort of straight-laced and sort of more institutional feeling. But I think over time, New York Metro and indeed the Eastern Seaboard more broadly across FinTech is adopting some of the disciplines and cultural attributes that have made the Bay Area so successful when it comes to early stage companies in the past. And if that continues to happen, I think it's going to be terrific for financial services broadly. And it will be awesome for me because I am a Sella ride away from New York City.
Well, and where do those differences leave companies that are outside the U.S. or who aren't in these major hubs that when they're trying to navigate, both getting capital, raising capital, and also dealing with regulators?
Yeah, I think there's three kind of gaps that people point to about other kind of metro areas, including the DC metro area. They point to talent gaps, they point to capital gaps, and they point to just sort of, kind of the robustness of the ecosystem around important issues like regulation, but there are others. I think the talent gap is, going to become increasingly easy to manage, and part of that is good news. Part of it is bad, right? Like we've got companies in Dublin where it's easier for us to get engineering talent there than it is in the U.S. because of like immigration laws that would never made any sense and continue to get worse, not better, in my opinion. I think part of the reason why we used to have a consulting business, right, was to be able to help companies navigate issues that are not exactly intuitive, that you can't necessarily reason from first principles, and hopefully that ecosystem continues to develop, because I think right now we don't have a shortage of good ideas or good people or good energy. I think some of the infrastructure is still developing.
Okay, well, Raj, I'm impressed that you managed to almost exactly
on
the time
the number.
on the number.
Yeah.
Thank you so much.
Thank you.
All right.